The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Jeremy, Friday the 21st, and it feels like we've had an interesting week, both in terms of macro and company news. Do you want to start us off by talking about what you've seen on the macro side?
Yeah, morning, Gareth. Really all about the UK, I'd say, this week. This week, the UK became the first major Western economy to report annual inflation at or below the generally accepted target of 2%, which I think is a cause for celebration. Didn't really see much of that in the press reporting of this achievement.
No, that's true.
A lot of the negatives talked around in terms of the measures of services inflation, which were ahead of expectation and going the other way, going up, not down, and measures of core inflation being stickier than headline inflation, which remain a concern. But, I think credit where credit is due, although the UK experience of inflation has in aggregate been worse than most large economies, the rate at which it is improving is faster than the US or Europe at the moment. And a lot of this, as we've talked about before, is the impact of energy and the way we account for energy in our inflation numbers. And energy is lower year on year. So we're getting this base effect on our inflation numbers coming through. But in the shorter term, in the last week or two, oil prices have been firming up. We've got issues ongoing as far as shipping is concerned and the Red Sea issues.
Still a worry, yeah.
And container rates and certain other areas of the supply chain for the UK economy are a bit troubling. But overall, we're on target. However, despite that, the other news this week from the UK was the bank's Monetary Policy Committee decision to leave rates on hold. And I think one has to conclude that the major factor in consideration of that has to be to avoid accusations of political interference during the general election.
The inflation data was pretty well received, actually. And you're right, people were focusing on some of the beneath, but there was also a bit of a political battle for people who disclaimed any involvement with inflation when it was going up to try and claim the benefit or the glory for making sure that they were associated with bringing it back down again.
Success has many fathers.
It does, yes. But sentiment does seem to be on the improve. I think that's probably fair.
Yeah, and overall, there's more evidence now that the Western world is entering a cycle of rate cutting. We've had the ECB and Canada last week, following on from some smaller economies earlier in the year. Mm-hmm. It's becoming increasingly clear that the UK will join that rate cutting party at the next opportunity, which will be in August. And although, as with the ECB last week, there is ongoing briefing around this subject, not to allow expectations of further rate cuts, i.e. one cut. We're going to wait on the data to see whether and how quickly further cuts will come through.
Got it.
And the other thing today is we've had some very strong retail sales figures for the UK for the month of May, with a 2.9% month-on-month increase, which more than reverses the 1.8% decline we saw in April, and comfortably ahead of the consensus expectation was of a 1.5% increase. So that, combined with some consumer confidence data from GfK saying that UK consumer confidence, albeit quite low still, is the highest it's been for best part of 2.5 years, really gives the feeling that the strengthening real income data, that real wages now, or wage settlements, are running comfortably ahead of headline inflation. It might not feel like wage earners are better off, but at the margin, they are better off.
Yeah.
And that does seem to be feeding through to a feel-good factor among consumers and improved spending patterns.
Yeah, and hopefully we'll start to see that in company results over the coming quarters. It'd be nice to see that showing through. Yeah.
So I think, looking forward, I think if inflation behaves itself, wage pressure can be contained, albeit it is running at a level that is of a concern to policymakers. The UK should, as I said earlier, join the rate cutting cycle come August.
Fingers crossed for that. We'll keep a close eye. Swiveling to the UK corporate scene, I understand that you've seen a bit more M&A coming through and some comments on fund inflows, which would be a delightful relief.
Yeah. The breaking news is that Britvic has revealed that Carlsberg has been making attempts to buy it. They rejected an offer of £12.50 per share. The board of Britvic have concluded that this offer significantly undervalues their company, its current and future prospects, which is an encouraging sign and something we've talked about before, that I think the attitude of boards is to be more resilient for when these offers come along.
Yes.
But Britvic is a large mid-cap business, and Carlsberg's indicative offer values it at over £3 billion. That's a further sign of the pent-up demand, I would say, in terms of M&A, private equity and trade buyers looking for prime UK assets, because on a global scale, they remain good value. So that's on the back of this week having confirmation that private equity is prepared to pay up to own Hargreaves Lansdown and is proposing to raise its offer. Alpha Financial Markets agreed another private equity offer valuing it at over £600 million. So this happening, in the teeth of a general election, which, although we've discussed before, I don't think is necessarily going to be consequential. Typically, you'd expect bidders in this type of activity to hold fire.
Yeah, it might hold off for a while, mightn't you?
This is ongoing. So I think it's probably indicative of the strength of the demand we're seeing. On top of this, Morningstar has revealed today that for the first time in 3 years, we've had the second consecutive month of inflows into UK small and mid-cap funds in the UK. So
that is good news.
Factor that on top of record share buybacks from strong balance sheets in the sector, increased dividend payments, and this M&A activity that can't contain itself, I think it's a very good setup for a continued resilient performance of the UK equity market versus global peers.
Yeah.
Don't want to get overly positive, but I think the relative attraction of the UK is still very much there. So what have you been looking at this week?
Well, slightly further down the market cap scale, some good news, but there's also been a couple of warnings come through. First of all, the good news on the progressive client side, we had Severfield, which is involved in manufacturing and in particular structural steel. They had results for the year to March, very solid results. They were ahead of expectations on profit, and there was a dividend beat as well. They're mainly benefiting from some good levels of spend, in particular from the tech sector. Big demand for data centers driven by overall sort of cloud computing demand, and in particular AI.
Yeah.
So that's been driving a good level of growth for Severfield. And they're also doing well from some of the push to renewable energies, which also require some of the sorts of things that Severfield makes. So they're seeing some nice structural growth drivers across some big parts of their business. Less positive, though, we had two profit warnings, one from YouGov. And YouGov's obviously best known for its polling data around elections, but the bigger part of their business is to do with consumer surveys and consumer opinion, and they sell that to enterprise customers. A lot of FMCG or consumer-facing businesses pay YouGov, and it was a pretty significant warning. You could argue it wasn't so much companies reluctant to spend on that sort of data, but more that there might be other ways of doing it. So if that's right, then that is a pretty structural concern for YouGov.
I mean, YouGov has traditionally been a very successful UK niche data provider that has grown very successfully over the years. But there's a number of things that might raise a few critical issues here. There's been quite a significant change of management.
Okay.
About a year ago, they made a big acquisition, 300 plus million, for the consumer panel business of GfK, which on the face of it should be a very complementary business, but that's quite a big chunk of an acquisition for a company like YouGov to assimilate.
Okay.
And although it was quite a significant warning numerically, the share price fell 46% yesterday. So it indicates there's a deeper seated problem than just a bit of a slowdown in one of its areas. And I think these issues could be a little bit more structural than at first sight.
Yeah, but certainly one worth keeping an eye on, because if it is a good business underneath, there might be a strong rebound if it goes well. So we'll keep an eye on that.
Kind of ironic all this happens at the time when the YouGov name is all over the press because of political polling.
Yeah, could have a good recovery. And yeah, it's a year of so many elections. You'd have thought the polling businesses should be doing very well. But yeah, if there are more structural concerns on the consumer enterprise customer side, then that is tricky for them. But yeah, we'll keep an eye on it going forward. The last one was Spectris, which is a measuring instrument specialist. And again, a warning from them. First of all, they had a delay in the ERP implementation.
That goes back a few years, doesn't it?
It does. It's more than 20 years since we saw the first one of those. So you'd have thought the ERP implementers would have learned how to do it without causing trouble. But luckily for Spectris, the way they're describing it, all it's done is delay revenue and profit from the first half into the second half. So it won't impact on the full year, but clearly a bit of a concern. But they have had a bigger issue with some demand in China for part of their product range, in particular selling into the Chinese EV market around batteries and battery design. And there's been a lot of press and speculation recently about what's going on in that EV market most broadly and the Chinese EV market more particularly. And clearly there are some challenges there, and Spectris hasn't seen the growth that they'd hoped for. So a bit of disappointing news from them, but probably in a broader context, interesting to see.
Yeah, this EV battery story, I think, has probably got some legs to it. There was an article in the paper today saying that EV car sales in Germany are down 30% over the last month. I was also talking to someone who is very well connected to the Chinese automotive industry. He believes there's 450 EV and battery manufacturing businesses in China. And he thinks of those, he was saying, only 3 of them are profitable. So, China is massively over-indexed on batteries and electric vehicles, and hence the reason that they're prepared to sell electric vehicles to the rest of the world for as little as $10,000. Of course, the rest of the world isn't having any of it. So, I think this is an issue that we'll see more of in the weeks to come.
Obviously, all the tariff wars beginning to hot up, and there will be a lot more to discuss. And what's lined up for next week?
We're getting US durable goods figures for May, which will show a slowdown from last month's 0.7% increase. And we're also probably more significantly going to get confirmation of Q1 GDP growth in the US, which is expected to confirm an annualized growth rate closer to 1% than the 3.4% they reported in Q4 last year, which is increasingly looking like a bit of a blowout number. So you've got the US economy slowing down. Any other Western economy would love to be growing at 1.3%, but I think it's the rate of decline of GDP growth that is going to be most closely looked at. And I think in comparison to the UK, which went through a shallow recession in Q4 of last year when the US was motoring ahead so strongly, is also going to report Q1 GDP next week and is expected to come in at 0.6% annualized rate, which clearly is not nearly as impressive. It's less than half the US rate, but these trends are traveling in opposite directions. And when you consider the degree of underperformance of UK assets compared to the US in recent years, who knows? It could have some impact in what's going on in the world. The other piece of macro data we'll get next week is the US PCE price index data, which year on year is expected to be slightly lower, but only slightly lower at 2.6%. Now, PCE is the inflation data that the Fed looks at most closely.
Okay.
So if there's a surprise on the downside, it's lower than 2.6%, we could get a little bit of bump in expectations for when the Fed will cut rates. Now, of course, they're going to be suffering from the same dilemma that the Bank of England is going through at the moment as the presidential elections approach in November. So most people's expectations is that we won't get a Fed rate cut till after that, maybe in the month of November. That could change. Let's see.
But softer US GDP or in particular the CPE data, that might suggest that the Europeans and the UK could be even braver in terms of moving well ahead of the Fed, or maybe even making additional cuts before the Fed starts to reduce rates themselves.
Yeah, that is a possibility for sure.
Yeah. Okay, good. Okay, we'll look forward to that news next week, and we'll catch up this time next week.
Okay, see you then.
Talk to you then. Thanks.
Brought to you by Progressive Equity.